Hey, welcome back to all of our market rebels and Stu. Pretty
Hey,
cool week so far. We had a good gap on Tuesday from CPI, but I think today kind of flat, wasn't it, at the
kind
close?
of flat. Yeah, last couple of days kind of flat, just kind of
Yeah,
hanging in
flat.
there. But definitely holding on to these gains, which is a really good sign for the Bulls.
Agreed. Yeah, that was kind of nice. So anyway, I was thinking about, I know we get a lot of questions about vertical spreads, and you do, especially with credit spreads, even though we know there's technically no difference, except maybe for the morphs. But so many people think that the credit spreads are just the only way to go. And
Free
what we
money.
thought would be
Don't they call it free money, Bill?
is certainly what it looks like when you talk to these people. That's what they think.
Yeah.
What we wanted to show you today was an interesting look at a vertical spread, something that professional traders know all too well, and it's this concept of discounts and premiums. And so that's what we thought would help people today. We will show you why it can be so valuable.
I'm
So
all about discounts. I like discounts.
the discounts are good.
Discounts are good, right?
So let's start off with a chalk talk question like we always do. This is a little thought-provoking question. So if you're new, please just take a moment to jot down your answer. And here's our chalk talk question. We'll come back at the end and give you the answer. But you bought the $100 call and sold the 105 call. Now, even though not stated here, it's the same expiration, same underlying stock. So it's a vertical spread. And the question that we have for you, will this have positive or negative theta?
Yeah, a couple questions you need to ask yourself, everyone. Is it a debit spread? Is it a credit spread?
Right.
You know, what is it? What do you actually have here?
And the fact that you bought it,
And the fact that
you would
right.
think would be a clue.
That's your clue. Well, that is your clue. Yeah.
And that's what a lot of people are going to look.
That's your clue about what to think about, actually.
That's the clue what to think about. Yeah. All right. So we want you to jot down your answer, and please do that. Jot it down, because otherwise it's too easy to say, I knew the answer. We want you to
Yeah. Commit.
commit to an answer.
Yeah.
Okay. So with that, let's go ahead and take a look at this topic called
Yeah.
discounts and premiums. And this applies to vertical spreads. And again, it's something that really all professional traders know. But I think it will help people who trade vertical spreads to see them in a different light. So let's start off with a little review for people who might be a little new to vertical spreads. It's a strategy where you are going to buy one option and you are going to sell an option. It has to be of the same type. That means they are either both calls or both puts. They are going to be different strikes and the same expiration. But basically, it's buying one and selling one. So let's say that you buy the 100 call and you sell the 105 call. Again, the same expiration. In the business, we would say that you are long or have purchased the 100, 105 vertical spread. We're just going to list those strikes in order.
And all Bill's doing here is he's just defining a vertical spread. It doesn't mean you have to buy same same strike, same month, all that, right? I mean, that would be
Those
something.
are different strategies. Yep.
A different strategy, but that's what this is. This is the vertical spread.
This is a vertical spread.
Same expiration, right? Vertically, like kind of where it came from. Like when you look at the matrix, it's up and down. So it's the vertical.
So this is going to be a debit spread because, why is that, Stu? Why is it? How do we know that's going to be a debit? Well, we know that the lower strike call for the same expiration must cost more money because it's giving you the right to pay less. So because you're buying the 100 call, I don't even need to know what the exact time to expiration is. I don't need to know the volatility. I don't need to know where the stock is. We know that the 100 call is going to cost more. So it is a debit spread. Okay, so that's kind of the basic definition. And if we were to put this position on, this is what our risk graph would look like. Right.
Bill,
so we know that.
Bill, can you repeat that line one more time? The lower strike gives the right to pay less.
Gives you the right. Right. You have, all things being equal, you'd rather have the right to pay 100 than to pay 105. So in the options market, you always have to pay for every benefit.
There you go. That's a benefit, right? So if you get the right to pay less, wouldn't you have to pay more for that?
You have to pay more for that benefit, right? Right. So we know that that's going to cost more money. And if not, little side note, there's what's called an arbitrage opportunity, which does create the situation for free money. And needless to say, that doesn't stick around very long. The computerized programs are going to pick that up long before you and I ever see it.
Yeah.
And that's how we really know ultimately that the 100 call has to trade more. for more. So this is what our risk graph looks like. Now at expiration, we're looking at the black curve. That just means right at, let's call it 3:59 p.m. going into that final minute on expiration day. That's what it looks like. Not the morning of, not late in the afternoon, going right into that final minute or seconds. That's the only time we look at the black curve. The current curve is right there in blue. And that shows us what the value of the spread is right now. Now, we've talked about this before. We always get a bend at the strike. So we can see we got a bend at the 100 and one at 105. Here's one of the things that you have to understand. Anytime the stock is to the right of this halfway point,
or going up,
we have positive theta because that blue line is going to move up. And that spread will, assuming we stay on this side, will eventually pay off 5. Now, that doesn't mean that's going to be your profit. It depends on what you paid for it. But the spread's value would be 5, and you will have positive theta. It's going to appreciate.
Little side note: people do that often. You have to differentiate between what the value of a strategy is.
Yes.
In this case, the vertical spread. Versus what your profit is. Your profit is all dependent, or loss for that matter, right? That's all dependent on what you paid or what you received versus the final outcome, in which in this case could be up to 5. And the difference would be your profit and loss, which is not what's the spread going to be worth at blah, blah. That's a different answer.
Right.
That's going to be there. Right. So you have to make sure that when, everybody's on the same page, that when you're talking about what's the value of the spread at 110 on the 100, 105, when you add in the words at expiration, it's going to be 5, right? That might not be your profit because you might have paid 2.
Right. No matter who you are, everybody who bought the 100, 105 vertical would have a payoff of 5. That's what the spread would be trading for. But depending on how you profited from it would depend on what you paid for it. So this example, it looks like we got a 250 cost and therefore a max gain of 250. But if we're on the left-hand side, we're going to have negative theta. That blue line is going to start moving towards the black, where we would have a payoff of 0 on the spread. So to see it in action, this blue line was shot. These are real prices, by the way, from a pricing model. These had 30-day stock expiration. I think it was 20% volatility. But regardless of the volatility, you're going to get a similar shape.
Yeah, we're not talking about extremes.
Yeah. 5 days later.
And another thing to think about on this 100, 105, buying the 100, selling the 105, think about it logically, everyone. Under 100 at expiration, they're worthless.
Both options are worthless, right?
Who's going to pay for a right to buy a piece of property, a piece of art, a piece of stock, a right to buy stock? Who's going to pay for that when it's over? The game is the final buzzer went off, so it becomes what's known as a worthless option. Right. On both of them, right? If the hundreds are worthless, the 105s are.
105s are definitely worthless,
right? And 0 from 0 is 0, and that's why you get the 250 down there,
right? Because we're assuming you paid 250. Now, if you had paid $1, this bottom line here would be lining up right there at $1,
and that would be
the basic shape would always be the same.
Mm-hmm.
So let's say that 5 days later, or 25 days until expiration, this blue line is going to move. Now, remember this, on this side of the graph, it's going to move up, and on this side, it will move down. So now it's going to go to this. 5 days later, 20 days to expiration, we go to the gray. Another 5 days, we go there. Another 5, we go there.
And what's happening here, everyone? Like, what is happening with all these different colored, beautiful, Crayola type lines here? What Bill is saying is, 5 days later, 5 days later, 5 days later, time is moving, right? Unless somebody out there has decided that they can figure out how to stop time, I'd kind of like to hear about that because I'm starting to get up there a little bit. That's what's going on, right? Every day is one less day in an option's life. And as these days go by, what are we doing to the extrinsic value? What is happening? Of course, all else being equal, we're not getting any movement we're just keeping the price of the underlying constant here, trying to isolate the extrinsic value. And what's happening with extrinsic value is the time goes by, it's going down, right?
Okay.
It's going to get to 0. And as it goes to 0, that's these different lines that you're seeing they're heading towards the expiration line.
Yep. So if we were to continue on, this green line would keep moving closer and closer, and we would eventually hit that black line. Now, again, another little side note that's interesting, if you line up, let's say, right at 105, the difference between these bottom two lines, you can barely tell, which means that a lot of the decay, they just didn't lose a lot of value. If you go between the orange and the gray, you can see a little tiny white gap. Now you can definitely see a little white gap between the gray and the yellow, bigger between the yellow and the blue, and a much bigger one.
That's right. Days are going by. More days are going by.
So, well, you're getting bigger chunks of that value taken off as you get closer to expiration. Yep, you're going off that steeper part of that time decay curve. So what we want to do is to explore what's going to happen at different levels. Maybe let's say if the stock is 3 points below from 100, maybe at 97, or 3 points above at 103. What are we talking about when we say it trades at a discount on one side and a premium on another? Well, let's do that, Stu. Let's say the stock is at 97, and if we put this into a pricing model, the $100 call model says it's worth $1.06. It says a 105 call is worth 22 cents, which means
your typical out of the money. What is this? 30 days out, Bill? Is that what you're doing?
Yeah,
right. 20. I think you said 20, maybe 30 volatility. It doesn't really matter. Your typical, the stock's 97. Keep in mind, everyone, people struggle with this. I find that the option strike is the option strike. You're not going to get a letter from, you're not going to get a memo from OCC and say, oh, by the way, we changed your strike. There may be a split involved, in which case you will get that memo. But, aside from that example, your strike remains the same. What's moving is the stock price. Right. The stock price is moving. So the stock price in this case is 97. This is 100 call. It's out of the money. The 105s are out of the money.
Yep.
They have a price. We already went through the pricing idea. The right to pay lower makes it more valuable.
Mm-hmm. And it is 106 compared to 22, right? Yeah. That will always be true. Now, we also see that they've both fallen in value because the stock has moved. The previous example, I had it at 102.50.
They've both fallen in value. So, do they fall in value at the same rate?
No,
absolutely
Good
not.
Question.
Absolutely not.
So what we want to take a look at here is it's going to cost you 84 cents. That is, you're going to spend $1.06. You're going to collect 22 cents from selling the 105. That's a net of 84, which is why it's a debit. You've got to pay for it. But take a look at the $100 call has zero intrinsic value. It's out of the money.
It's out of the money. Plain and simple. It's out of the money.
Therefore, the 105 also has zero. So another thing to think about this as a trader is this. If expiration occurred right now, what's the spread worth?
Just play that game with yourself. If expiration
what's it worth now? It's worth.
What's the value of the 100? What's the value of the 105? And then pretty soon, if you do that like once, you'll figure out that they're both zero, and the value of the spread is 0 minus 0 or 0.
Yep. However, we got to pay 84 cents for it.
Ugh. Pain.
So the thing is that in the business, we would say that it's trading at a premium to intrinsic value. There's no intrinsic value, and yet you still have to pay for it. That's where we're getting this term about premium. So anytime that we see the spread's value, in this case, 84 cents, is greater than the intrinsic value, it's trading at a premium. All right.
So the question that begs here is, why would somebody pay 84 cents for something that's worth zero?
Zero right now.
Zero right. Yeah, exactly. Zero right now.
Because there's time on it.
There's time on it. What can it become?
Right. Could be worth a lot. Well, in this case, the most at 5, but certainly worth a whole lot more than 84 cents.
Could be worth 5 at some point.
Mm-hmm.
Right. That's why you'd pay 84 cents for it, because it could be worth more.
Yep. And the spread will decay over time. This is an easy way to figure it out. You're paying 84 cents for something that has no intrinsic value now. All right. So that's trading at a premium. All right. So just remember, anytime the spread's value is greater than intrinsic, it's at a premium. All right. Let's try the other side. Let's go 3 points in the other direction to the stock price of 103.
Okay.
Now the pricing model says the $100 call is worth $4.12. 105 is worth $1.51. Again, the 100 call is worth more. And the 100-105 vertical is trading for $2.61. That's just $4.12 minus $1.51. But notice that the $100 call has $3 of intrinsic value. Remember, the stock is up here at 103. So the 100 call has $3 of intrinsic value. The 105 doesn't have any. So we know that if expiration occurred right now, the spread is worth $3.
And the 412 should be no shock to anyone here. How did something that was 1 and change go from 4 to 12? Well, there's $3 of intrinsic value.
Right. Yeah, you've got some intrinsic value into it now.
Intrinsic value. The rest of it, the extrinsic, that's anybody's guess, depending on what the implied vols are. There's going to be some, most likely, depending on how much time is left.
Sure.
So, that's how it went there. That's, all of a sudden there's like $3 in there. $3 plus any extrinsic is going to give you 412. And of course, we know the 105s are still out of the money.
Out of the money.
They went up as well. Right. The stock is getting closer to 105. They're getting closer to being at the money. Remember, the strike price didn't change. The stock price changed. They're getting closer to being at the money. And we know that the at the monies carry the most extrinsic value.
Exactly. So take a look at what's going on here. Now it would cost you $261. And remember, it doesn't really matter what you paid for it. You could have paid $1 for it. Right now it's worth $261. But there's $3 of intrinsic value. And so if expiration occurred right now, this is another little test you can do. You'd say, oh, I can tell this spread would be worth $3. So it's trading at a discount to intrinsic value. You're only paying $261 for $3 of intrinsic value. So the point to understand here is that anytime the spread's value, that's his price, is less than the intrinsic value, it is trading at a discount and it will appreciate over time. So this is kind of interesting, where you hear a lot of people say, oh, I would never do the debit spread, because they say it's only going to depreciate or have this negative theta. Not necessarily. It depends on which side of that halfway point you're on. That's the thing you have to understand as a trader. And it also could move while you're holding it. It might have started out as positive theta, but that doesn't mean it is right now. And
Bill, do we have a slide that shows the extrinsic value just on the 100 and the extrinsic value just on the call, which is obviously 151?
I don't. We're going to look at an Excel spreadsheet. We can kind of back into it. Yeah, we'll look at that in just a moment. So right now, I just want to make sure that everybody understands this idea of discounts and premiums. We're just saying, what is the spread worth? Not what you paid for, but what's it worth versus how much intrinsic value is there.
Think about what you're doing. Think about what you're buying, what you're selling.
Yeah. If you're paying $261 for something that, if expiration were right now, would be worth $3, you're buying it at, in this case, a 39-cent discount.
Right. Which means what? Which means you're selling more extrinsic value than you're buying. Period.
You must be selling more. We're going to talk about that. Exactly. Everybody thinks that that's a debit, but it could actually be a credit when you understand it's the extrinsic values. So the question that we want to figure out here, that we think is going to be beneficial for all of our traders out there, where does the spread switch from a discount to a premium? At what point on that graph is it going to switch? So that's what we're going to figure out. And before we do, as always, for anybody who's new, please check us out at marketrebellion.com/get started. A lot of great free materials, videos. I think there's some online courses, PDFs, things to help you get started. All right. And that will go a long way into getting you on the right track. So here's what you want to remember. In our example, we did the 100-105 vertical spread. We can tell it because that's where the bends are. And if you just look at a dividing line, roughly speaking, that would be 102.5, right? 100-105, the halfway point would be 102.50. Anytime the stock price is below 102.50, it's going to trade at a premium. And anytime it's on the other side, it's going to trade at a discount. Now, there are some very slight nuances that can occur down here, or if we start including cost of carry. But roughly speaking, this is really what you want to understand. Okay, so to look at this in action, let's bring up an Excel spreadsheet here, Stu. And what I've got here, you can see in this tab, this is the 100-105 vertical, and we've got various stock prices down here. Here are option pricing model prices for the 100 call, for the 105, and then the spread is just simply taking the 100 minus the 105. Pricing model prices for the 100. And the intrinsic value shows us the intrinsic value of the of the 100 call, and here it's the intrinsic value of the 105. And over here, I've got Excel program to figure out if it's trading at a premium or a discount. And all it's going to do is it's exactly what we looked at. What's the value of the spread and how much intrinsic value is there? All right, so let's do some examples. Let's look down here with the stock at 100. What's the spread worth? $1.96. How much intrinsic value is there? Well, the stock is 101. The $100 call has $1 worth of intrinsic. There's $1 worth of intrinsic, but you're paying $1.96 for it. It's trading at a premium.
It being the spread, everyone, right? Buying one, selling the other, buying the vertical spread.
Exactly. So now if the stock is 101.50, the spread is worth 212, and yet you've only got $1.50's worth of intrinsic value. It's still at a premium. Down here at 102, what happens? The spread is worth 228, but you only have $2 of intrinsic value, still at a premium. But look what happens when you go to the halfway point.
Yeah.
Now the spread is 245, but you've got 250 of intrinsic. It has now flipped to a discount.
And 99% of the time, you're going to find it to be this way.
Yeah, exactly. Now, again, we could get into really small nuances, some little inflection points where we start talking about the cost of carry. But most of the time, spread traders are 30, 60 days out or something. This is, for a rough rule of thumb, as your guide, this is always going to be the case.
It's good, give or take. It's going to be right around that halfway point. Yep.
Yep. And this is going to be the discount until, if you want to get real technical, eventually, either as we get closer to expiration or go super deep in the money, this would eventually be paying $5 for $5 of intrinsic value. They would just kind of trade at parity. But by then, you're probably long out of the spread. So what we really want to figure out is that it's this halfway point.
Maybe, hopefully, you're out of the spread.
Hopefully, should be out of it.
Yeah.
But we can see that it's this halfway point, right? It's also kind of right where the red curve, the current curve, is crossing the expiration graph. All right, so that's an example at 20% vol. Let's do the same spread at 40% vol.
Can I make an off the cuff remark here?
Of course you can.
So if you have the 105, if you have the 100, 105 call spread on, and that call spread is trading at parity, in other words, it's trading right around 5, and you still have it on,
that's a bad idea.
You should hire a coach.
That's what we call it. What do we call that, Stu? There's a special name in the trading business that we call that.
I don't know. What is it, Bill?
That's a danger.
Oh, yeah, right. Risk versus danger. Can you make anything?
Nope.
Versus what you can lose.
You could certainly lose 5, but you can't make any more. We actually
when
call
you cross that bridge, when you can't really make any more money, and that's a little bit of a relative term as well, 490, 480.
Exactly, right. It's close
enough.
Really
make anything, yet you can set yourself to get your butt kicked.
You're sitting way up here into the spread. You're sitting way up into the spread where that little white sliver between the red and the black is so tiny.
So tiny.
What's the point? But yet you could come crashing all the way down here.
Yeah.
All right, so let's take a look at same idea, but we're going to go to 40% vol. These prices are at 20%. We're now going to double the volatility. And now look what happens. Let's do the stock at 101. Now we can see the 100 call is worth 511. Let me bring this up a little bit. And the 105 call, sorry about that, is at 298. We've got 214. That's the value of the spread. Now it's been pushed down because of the higher vol. We have $1 worth of intrinsic value. Stock is 101. The $100 call has $1 worth of intrinsic, but you got to pay 214. You're paying more than the intrinsic value. You are paying a premium to intrinsic.
Isn't that interesting?
And now look what happens when we come up to the stock at 102. The spread is worth 230, but you have $2 of intrinsic. So you're paying $230 for 2. We're getting close.
Getting close.
Still at a premium. And then as soon as we hit the halfway point, it is now trading for $239. but we have 250 of intrinsic, and we have now flipped ever so slightly to the discount side, and that will stay all the way through.
Bill, are you trying to tell me that I can own a debit spread yet collect premium?
That's what we're heading up to. And this is where a lot of people make the mistakes. They go, oh, I only want positive theta. This is a debit spread. If the stock is up here at 105, you're or 106 or 7, you've got positive theta. It's going to appreciate over time, even though it's a debit spread. Conversely, if this were a credit spread, we'd be doing puts, the 100, 105 puts, and you're on this side, you got negative theta, even though it's a credit spread. So that's what part of what we're trying to show you here. It's not so much about debit and credit. It's a question of, are you on the left-hand side of the halfway point or on the right-hand side? And that's something we find every single trader misses.
Right. It's a question of, do you own the extrinsic value or?
Exactly. It comes down to the net extrinsic. In fact, let's take a look at that, Stu. So here's the 100 call. It's trading at a premium. Now think about this. With the stock at let's go to 101. We have $1 worth of intrinsic value on our 100 call, but the 100 call is worth $5.11. So how much extrinsic value do we have? $4.11. We own $4.11 of extrinsic value, but we've only sold off $2.98. We have more extrinsic value that can decay than what we can collect. That's why we're going to be on the negative on the premium side. We're going to be on the negative theta side.
Mm-hmm.
Once we come over to this side, let's do it at 103. Now the option's at 629, and this is where people start getting scared and going, oh, it's going to start depreciating. But how much extrinsic value is there? It's 329. And how much have we sold? 382. Okay, so we've got more extrinsic value that is on the short side than on the long side. That's another way to understand why we're on the discount side, even though it looks like we've got a much more expensive option that we own.
See, when you take the cash portion out of it, i.e. the value, and you just isolate the extrinsic, you find out that you've actually sold more extrinsic value than
correct.
And you're now
that's what makes it a credit spread. And we try to get that through to people, and they just don't seem to get it. It's always about, well, I sold it or I bought it, and that really has nothing to do with it. I could make this a credit spread. I could make it a debit spread. It's a credit spread up into here.
Yeah, the 100, 105 long.
I'm sorry, it's a credit spread down into here because we have sold more extrinsic value than we own.
And you know, to test yourself, you can always go to the other side of the street and look at the put side, and the put side is going to be the difference, excluding any cost of carry. The put side is going to be the difference between the distance between the strikes and the cost spread. You know, you have a $2 cost spread, the put spread is going to be $3. It'll be a credit. Right, the debit is going to be on the cost side, the credit is going to be on, and the risk reward profiles that we've done countless times, Bill, is going to be 100% exactly the same.
Exactly the same. And people just don't get that. That's part of what we're trying to show you here. You have to understand the inner workings of options to successfully trade them. So if this is new to you and you're going, what in the world are they talking about? This is where the money is made, by understanding how the money is generated, how it's gained, and how it's lost. Let's do another one here, Stu. What if we widen these out? Let's go back to 20% vol. Let's do a 100, 110 vertical.
Yeah. I don't think it's going to change, but let's see.
There we go. All right. So let's come down here to stock price of 104. We have a stock price, it's a little far, it's 486 that we own. The 110 call is worth what? 53. It's worth $4.33. And we have $4 of intrinsic value. So we're paying $4.33 for $4 of intrinsic. We're paying a premium. We're on the left.
Again, that intrinsic column is it's you know, you shouldn't have any problem with that. It's $4 in the money. Period. Yeah. It's just $4 in the money.
Mm-hmm. So we can tell that it's at a premium on this side, and because of that, we have negative theta. Now, what happens if we come up to 105? That's the halfway point. We have 554. By the way,
would be a long gamma spread.
We would actually be into this side. We're going to start getting into the short gamma, but that's on that side, exactly correct. We'd be on the long gamma side. And then if we've got 73 cents, it's going to cost us $4.92, but we have $5 of intrinsic.
Nice.
So we have finally flipped to the discount. Now, again, this doesn't necessarily mean good or bad, because as Stu just mentioned, we're actually on the negative gamma side. We've got negative gamma, negative vega. Yes, we do have positive theta. Depends on what our goals are. But what we want you to see is that there's this whole concept of going from premiums to discounts once you flip past the halfway point. And that will be true all the way down.
Yeah. And, while we're on the topic, here's where everybody, I'm going to be nice here, messes up. They got the 100, 105 call spread on.
Yep.
Stock blows through 105.
Mm-hmm.
And all of a sudden, there's panic in the air.
Oh, yeah.
There's all of a sudden, the stock's now 106. Oh, my God, my short's getting killed. Well,
all you're doing is you're squeezing this red and black line together. It's doing exactly what you want it to do.
Exactly. You want to get run over on your short. That's what's going to create the highest profit for you.
Yeah.
Right. It's going to, the higher it goes, the more it's going to move towards a net of 5.
Yeah. See, down here, the spread is trading for 982. What's your net intrinsic value? 20 minus 10 is 10. So we've got 982 is almost worth 10. It's at a slight discount by 18 cents, but they're starting to trade at parity.
Sold.
Yeah, sold.
Sold.
So that's really what we thought was kind of a neat little thing to show some of the newer traders out there. Just remember, as a recap, it's this whole idea of discounts and premiums for any vertical spread. You got the 100, in this case, the 100, 110, take the halfway point, 105. If you're on the left-hand side of it, you are trading at a premium. You're going to be paying more than the amount of intrinsic value that you have. That doesn't make it bad. It just means that you've got negative theta. But you also have positive gamma. If you are on the right-hand side of the halfway point, you're now trading at a discount. But you've got negative gamma, negative vega, but you've got positive theta. So again, if all of those terms are going, you're thinking, oh, hold on, what did he just say? What we try to show you, one of the things on Coach's Corner, is that there are a lot of moving parts, not only with calls and puts, but with strategies. And if you don't understand these, this is where the money's being made. Not just going, I think the stock is going up. You have to understand, if you don't understand where the money is coming from, you're trading on luck.
Yeah.
And that's not a real,
you don't want to do that. And there's so many applications to this. Like, you can own a call spread.
Oh, yeah.
Right. I have a client, I remember recently, he owned the call spread and it was trading around 480 or so.
Yeah.
So he was out there, he was trading at 470, 475, maybe 480. So he puts it out there to sell at 480. I said, man, you're not going to sell this at 480 until the put spread is actually trading under 20 cents.
Under 20 cents. Yeah.
So I said to him, I'll tell you what, when the put spread is trading under 20 cents, I want you to lift your own offer in the call spread and buy the put spread.
Yeah.
And his head was like, he went crazy. Right. But I was trying to get him to see the relationship between the extrinsic value on both sides of the street here. Right. One complements the other. At 480, why would somebody pay 480? Well, if they can lock in 10 cents by buying the other one for a dime, they're going to do it.
I'm
going to do it. So probably somebody else is going to do it. So look, it's all about, that's what an option is, everyone, right? It's not the intrinsic value. Of course, that's on the table and you got to buy it. But it is cash. It's the extra. That's when we talk about optionality generally. That's what we talk about, like what's
over and above cash.
What's the curve? That's what creates the curvature. Stock has no curvature. It's just up or down, right? It's just that line that kind of goes like that or like that. There's no curvature. It just goes on forever. It goes up forever. It goes down forever until, of course, it gets to zero and then it stops. But by then it's way too late. The option is a full game because it has this curvature to it.
Yep. So let's do one more to make sure people understand that, because this is where people make these mistakes. Let's say the stock is 106 and they go, oh, my long option is going to really start decaying now. I must have big time negative theta. Well, the call is worth 648, but you have $6 of intrinsic value. So how much extrinsic do you have? 48 cents. But how much are you collecting? 97 cents, you actually have a discount. You actually have positive theta because you've sold off, at least at this point, more extrinsic value than you've paid. People don't see it. They just go, oh, I've got an option worth 6.48. No, you don't. You've got an option worth 48 cents. You've got $6 of intrinsic value. Don't count the cash. And so again, these are all wonderful insights, not only just from calls and puts, but you can see when you start stacking with vertical spreads, they become critically important to understand. So we hope that gave you some new tools to work with. And with that, Stu, let's jump over to our Chalk Talk question. So what do y'all think? You bought the 100 call, sold the 105 call. Will this have positive or negative theta? Well, if anybody who's been on our channel for a while, Stu, knows that there's usually some element of a trick question to it. And hopefully everybody out there got it. It depends. You can't say, well, I bought it. It's a debit spread. Therefore, it has negative theta.
Yeah.
It probably does at that moment, but not necessarily. It depends on where the stock was.
Depends on the
stock and where the stock is. Right.
As that chart that Bill, the Excel spreadsheet that showed, it all depends.
All depends.
The stock is 5, you're collecting. If the stock is 95, you're paying.
You're paying. But you see how easy it is now. I don't even need to see what the option prices are, whereas most traders would. They'd say, well, what's the call
also keep in mind that because of the curvature, it can go from I'm paying to I'm getting.
Oh, sure. Oh, yeah.
And vice versa.
Absolutely. But those are some of the little professional trading tips that we like to show people, because we often find that traders will say, well, what's the call trading for? What's this? What's that? And they're looking at things that just don't matter. It's just a question of whether you're on the left half of the halfway point or on the right half. And so now you've got a nice little model you can work in your head and kind of figure out your discounts and premiums. And we hope that gives you some good things to think about as always. Stu, any closing comments?
What's our famous line by Mr. Levick?
Know your risk.
Know your risk. Know your risk.
That's a beautiful way, good way to close for vertical spreads. It's a wonderful way to figure out your theta risk.
Yep. Our friend Steve Levick, formerly of Spear Leads and then Goldman Sachs, know your risk.
And this is a wonderful way to come down to the answer quickly. And we hope that gives you some things to think about. And if so, please tell all of your other trader friends, join us next. Oh, no, I think next Thursday we're off, aren't we, Stu?
Yeah, Turkey Day. So I
think that's Turkey Day,
everyone.
So happy Thanksgiving early. We will look for you the following Thursday on Coach's Corner, and we'll see you then.
See ya.